up 27% yesterday, down 9% today. If you're staring at the SK Hynix tape completely blind, you'd assume the macro AI memory trade is officially dead. But the underlying mechanics prove the retail consensus is dead wrong.
While the US ADR is experiencing wild liquidation, the domestic underlying stock in Seoul is operating in an entirely different universe. This 30% two-day volatility matrix isn't an AI bubble, it's a structural pricing glitch. Before we dissect the exact regulatory barriers freezing the cross-border arbitrage channels and look at the upcoming July 29th terminal timeline, smash like and subscribe. For live dark pool sheets, check the explanation links. Reviewing the tape, Hynix wrapped the session, flushing 9% to lock in at $176.46. Even with this local drawdown, the broader institutional accumulation framework remains heavily protected after the historic high-volume squeeze. The core question dominant across retail desks is simple. Why is the US ADR trading at a massive valuation premium to the Korean common stock? Mainstream tourists think it's a bubble, but it's pure market structure. Bottom line, you can't just buy the regular shares in Korea and instantly swap them for the pricey US ADR. South Korean regulators officially blocked all conversions for this new batch until a hard deadline on July 29th. Until that date hits, domestic long inventory cannot be converted into liquid USA DRS. The cross-border arbitrage channel is completely clogged, leaving zero mechanism for global macro funds to flatten the pricing anomaly. Even past the July 29th window, structural mechanics will remain tight. While converting a DRS back into domestic KOSPI shares is frictionless, the reverse path faces strict outbound volume quotas from Seoul regulators. This structural mismatch means retail traders cannot efficiently execute this spread trade. The administrative overhead and foreign exchange reporting requirements ensure that only massive Tier 1 desks can move the capital. This extreme pricing behavior isn't entirely unique. TSMC has historically sustained a systemic 10% to 20% ADR premium spread over its Taipei common stock for years, purely due to advanced institutional access constraints. Compounding the local tape pressure, macro headwinds are heating up in Seoul. The Bank of Korea just executed a surprise hawkish rate hike, instantly raising corporate debt financing costs across the domestic tech bloc. Simultaneously, regulatory oversight desks are stepping in to audit hyper-volatile semiconductor ETFs, forcing leveraged retail syndicates to defensively de-risk their books and accelerating the local intraday flush. But looking past the technical friction, the structural microeconomics of Hynix remain untouched. Merchant HBM demand is completely sold out, and advanced packaging allocation for NVIDIA and AMD remains ultra-tight. Let's test your active portfolio conviction on this massive cross-border pricing divergence. Will the extreme ADR premium completely collapse once the conversion window opens on July 29th, or does the US tape head higher? Comment below. To capture our real-time institutional entry clusters, automated Delta options sheets, and private community workspace alerts to front-run the next advanced hardware and semiconductor rotations, tap the description links right now.